Imagine you walk into your bank on a Wednesday morning. Not just any bank. The 16th largest bank in America, $209 billion in assets, marble floors, professional staff. They pass every regulatory test. Their balance sheet shows 15.3% capital ratio, well above the 6% minimum. According to every official measure, this institution is bulletproof. You deposit your paycheck, you go home, you sleep soundly. 48 hours later, that bank is dead. Not wounded, not struggling, completely vaporized. And here's the thing that should terrify you. It wasn't subprime mortgages, it wasn't risky derivatives, it wasn't fraud. The bank failed because it did exactly what regulators told them was the safest thing possible. They bought US Treasury bonds. The textbooks call them zero-risk assets. The regulations treat them as bulletproof. Every banking expert in the world spent the last decade saying, if you want safety, buy government bonds. But in March of 2023, those safe bonds became financial poison, and $620 billion in hidden losses appeared across the American banking system overnight. The collapse nobody saw coming wasn't caused by reckless behavior. It was caused by following the rules. Silicon Valley Bank, March 8, 2023. The announcement comes at market close. $1.8 billion in losses from bond sales. The stock doesn't drift down. It doesn't gradually decline. It collapses 60% in hours. Traders are confused. Analysts scramble. This isn't supposed to happen to banks like this. By March 10th, 72 hours after the announcement, the bank is in federal receivership. $209 billion in assets evaporated. The 16th largest bank in America. Gone in the time it takes most people to plan a weekend. Now here's what makes this collapse different from every banking crisis you've studied. There were no subprime mortgages hidden in the portfolio, no exotic derivatives that nobody understood, no rogue traders making billion-dollar bets in London basements. Silicon Valley Bank's executives didn't commit fraud. They weren't running a Ponzi scheme. Their Tier 1 capital ratio sat at 15.3%, more than double the regulatory minimum of 6%. According to Basel III requirements, the international framework governing bank safety across 28 countries, this institution was well capitalized. It passed stress tests. It met every regulatory benchmark. The Federal Deposit Insurance Corporation had been spending 2021 and 2022 assuring Americans that regional banks were sound. Treasury bonds carried zero-risk weighting in regulatory frameworks. The official message was clear. These institutions are safe. Your deposits are protected. The system is stable. Banking regulators were so confident that they published reports showing strong capital positions across the sector. The numbers looked solid. The compliance boxes were checked. But there was something in Silicon Valley Bank's portfolio that regulators classified as completely safe. $117 billion in securities, mostly US Treasury bonds and mortgage-backed securities guaranteed by federal agencies. These weren't speculative assets. These were the investments that every textbook, every regulation, every banking expert called the safest place to park money. 0% risk weighting under Basel III meant banks could hold unlimited quantities without increasing capital requirements. It was actually optimal to load up on these assets. The more government bonds you held, the better your regulatory ratios looked. Between March 2022 and March 2023, the Federal Reserve raised interest rates from 0.25% to 4.75%. The fastest monetary tightening since Paul Volcker fought inflation in the early 1980s. But here's the detail that changes everything. When you buy a 10-year Treasury bond at 1.5% yield and interest rates rise to 4%, that bond's market value doesn't stay stable. It drops approximately 20 to 25%. Basic bond mathematics, present value calculations. The higher rates go, the less your old low-yielding bonds are worth. Silicon Valley Bank had purchased most of those $117 billion in securities when rates were near zero. As the Federal Reserve jacked rates up in 2022, those safe bonds lost $15 to $20 billion in market value. But here's the accounting trick that hid the disaster. The losses were classified as unrealized. As long as the bank held those bonds to maturity and never sold them, those losses remained invisible on public financial statements. Regulatory filings showed them at purchase price, not market value. Depositors had no idea. Investors had no idea. Even sophisticated analysts looking at public disclosures couldn't see the hole in the balance sheet. To understand how this happened across the entire banking system, you need to see what regulators created between 2020 and 2021. Regional banks were suddenly flooded with deposits. Silicon Valley Bank's deposit base exploded from $61 billion in 2019 to $189 billion by 2021. Tech boom profits poured in. Pandemic stimulus checks flooded the system. The Federal Reserve's money supply measure, M2, increased by $6 trillion. Banks were drowning in cash that had to go somewhere. The regulatory framework gave them a clear answer. Treasury bonds carry 0% risk weighting under Basel III. Mortgage-backed securities guaranteed by federal agencies also get 0% risk weighting. This wasn't a suggestion. This was the foundation of international banking regulation adopted after the 2008 crisis. If you hold government bonds, you don't need to increase capital reserves. You can load up infinitely without triggering regulatory requirements. Duration risk, the sensitivity of bond prices to interest rate changes, was essentially ignored. It didn't appear in stress tests. It didn't factor into capital requirements. So banks did exactly what the incentive structure encouraged. They bought long-duration bonds yielding 1.5 to 2.5%. Silicon Valley Bank put 78% of its assets into these securities. The average duration of their held-to-maturity portfolio was 6.2 years. Every major regional bank followed similar patterns. The strategy made perfect sense under the regulatory logic. Earn a small but steady yield on safe assets while meeting all capital requirements. The fatal assumption was baked into Federal Reserve guidance itself. In 2020 and 2021, the Fed's own forward projections said interest rates would stay near zero through 2023. Bank executives weren't making wild predictions. They were following the central bank's published expectations. The entire portfolio strategy across the regional banking sector was built on this foundation. Then reality shifted. March 2022, the Federal Reserve began the fastest rate hiking cycle in modern history. By March 2023, the Fed funds rate hit 4.75%, up from 0.25%. Every 1% increase in interest rates causes approximately 6% loss in value on a 6-year duration bond. Run that calculation on Silicon Valley Bank's $91 billion held-to-maturity portfolio. $15.2 billion in unrealized losses. The safe assets had become toxic. But Silicon Valley Bank wasn't alone. Fourth quarter 2022 data from the FDIC showed the scale. Banks with assets between $100 billion and $250 billion held $78 billion in unrealized losses. Banks with assets between $10 billion and $100 billion held $291 billion in unrealized losses. Community banks under $10 billion in assets carried another $109 billion. The total across the entire American banking system was $620 billion in hidden losses sitting on balance sheets that regulators still classified as well capitalized. These weren't paper losses in some theoretical sense. They became brutally real the moment depositors wanted their money back. When you need to meet withdrawal demands, you have to sell bonds. Selling those bonds at current market prices locks in the losses. Locking in losses reduces capital. Capital reduction triggers regulatory scrutiny or depositor panic. Panic accelerates withdrawals. More withdrawals force more bond sales. More sales lock in more losses. The death spiral runs on physics, not sentiment. March 9th, 2023. Silicon Valley Bank's depositors withdraw $42 billion in a single day. Not over weeks. Not gradually. $42 billion in 24 hours. The bank run happened at the speed of Slack messages and smartphone apps. Venture capitalists texted each other. Startup founders shared warnings on Twitter. By Thursday evening, the bank was already a corpse. Regulators arrived Friday morning to find the building empty of liquid assets. March 10th, the FDIC takes control. 93% of deposits were above the $250,000 insurance limit. Without intervention, tech companies with payroll accounts, venture firms with operating funds, wealthy individuals with millions on deposit all faced potential losses. 2 days later, March 12th, Signature Bank is shuttered. $110 billion in assets. New York state regulators don't wait for a run to finish. They close it preemptively. The official reason mentions cryptocurrency exposure, but the underlying problem is identical. $3.6 billion in unrealized bond losses combined with nervous depositors. Signature had strong traditional banking metrics. Capital ratios above requirements, no fraud, no reckless lending. But it was close enough to crypto and close enough to Silicon Valley Bank that regulators decided it couldn't survive the weekend. This is a new category of failure, too connected to panic to be allowed to open Monday morning. First Republic Bank becomes the slow-motion collapse that proves emergency measures don't stop contagion once confidence breaks. March 16th, 11 major banks coordinate a $30 billion emergency deposit injection. Bank of America, Citigroup, JP Morgan, Wells Fargo, the giants of American banking, publicly demonstrate support. $30 billion of their own money placed in First Republic to stabilize it. The message is clear. This bank is sound, backed by the strongest institutions in the country. Depositors don't care. In the first quarter of 2023, they withdraw $102 billion. Nearly half of the bank's total deposits vanish despite the largest private sector rescue attempt in modern banking history. The stock price tells the story. $147 in February, $3 by May. First Republic's business model was built on serving high-net-worth clients, with average account balances exceeding $500,000. 68% of deposits were uninsured. Those wealthy depositors had the means to move money and every incentive to move it first. The higher quality the client base, the faster the run. May 1st, 2023, First Republic fails. The FDIC sells it to JP Morgan Chase for $10.6 billion, roughly 5 cents per dollar of assets. The Federal Deposit Insurance Fund absorbs an estimated $13 billion loss. JP Morgan gains a wealthy client base, $92 billion in loans, $30 billion in securities, and 84 branches in premium coastal markets at Depression-era prices. By spring 2023, Moody's Analytics research identifies 186 banks facing critical vulnerability, not speculation. Specific institutions with unrealized losses exceeding 50% of their capital and significant uninsured deposit bases above 50% of total deposits. The fragility isn't limited to California tech banks. It's geographic. It's structural. Regional banks holding 70% of commercial real estate loans, community banks serving local markets with concentrated deposit bases. The crisis revealed that the entire middle tier of American banking was built on an assumption that broke. Rates would stay low forever. Sunday night, March 12, 2023. The Treasury Department, Federal Reserve, and FDIC issue a joint statement. All Silicon Valley Bank depositors will be made whole. Not just the insured amounts up to $250,000, every single deposit, including accounts holding $50 million, $100 million, amounts that dwarf the insurance limits. The announcement comes with a new facility, the Bank Term Funding Program. Banks can now borrow from the Federal Reserve using bonds as collateral, but here's the critical detail. Collateral is valued at par, at face value, not current market value. A bond worth 75 cents on the dollar today gets treated as if it's worth 100 cents for borrowing purposes. The Fed is letting banks pretend their unrealized losses don't exist. Within weeks, $163 billion flows through the Bank Term Funding Program. Discount window borrowing hits $153 billion, breaking the previous record of $112 billion set during the 2008 financial crisis. Total Federal Reserve emergency lending exceeds $300 billion in a matter of days. To put that in perspective, the TARP program in 2008 authorized $700 billion, though less was actually deployed. This intervention reached 40 to 50% of TARP's scale in 2 weeks. The political framing is immediate and calculated. This is not a bailout. The Biden administration repeats this phrase in every statement. Depositors are being protected. Shareholders of failed banks are wiped out. Management is fired. Banks that failed face consequences. But look at who actually received protection. Venture capital firms with $50 million on deposit at Silicon Valley Bank. Tech companies with $100 million in operating accounts. Wealthy individuals with accounts 10 or 20 times above insurance limits. Corporate treasuries that parked huge sums in regional banks for fractionally higher yields. These entities were made whole at taxpayer risk. The moral hazard couldn't be clearer. If your bank loads up on duration risk with long-term bonds at low rates, you're protected when rates spike. If your bank fails fast enough, you get full protection regardless of insurance limits. Too fast to fail becomes the new too big to fail. The message to bank executives is simple. Take the risks that regulations encourage, and if things go wrong quickly enough, the federal government will backstop your uninsured depositors. The cost lands on the FDIC's Deposit Insurance Fund. Before the crisis, it held $128 billion. Silicon Valley Bank's failure cost the fund an estimated $20 billion. First Republic cost $13 billion. Total crisis costs exceed $30 billion, nearly a quarter of the fund's reserves. The remaining banks in America will pay higher insurance premiums for years to cover these losses. The healthy institutions subsidize the failures. But here's what didn't get reported in the immediate aftermath. The $620 billion in unrealized losses across the banking system didn't disappear because the Fed created an emergency lending program. The commercial real estate exposure didn't vanish. The structural incentive allowing banks to hide interest rate risk through held-to-maturity accounting stayed in place. The crisis wasn't resolved. It was postponed. The emergency facilities bought time, but time doesn't fix balance sheets when the underlying assets are still underwater. Third quarter 2024. The unrealized losses sitting on bank balance sheets total $513 billion, down from the $620 billion peak, but still massive. Still systemic. $3.5 trillion in held-to-maturity securities remain on the books. If interest rates stay elevated or rise further, those losses persist or worsen. The emergency has faded from headlines, but the fragility hasn't been fixed. January 31st, 2024, 10 months after regulators declared the banking crisis contained. New York Community Bancorp announces a $552 million quarterly loss. The bank had acquired Signature Bank's assets after that failure, giving it significant exposure to New York metro commercial real estate. $44 billion in commercial real estate loans, representing 38% of total assets. The stock crashes 38% in a single day. Within a week, the market value drops 60%. The bank is forced into an emergency $1 billion capital raise from private equity at distressed terms. This is the second wave nobody wanted to acknowledge. Commercial real estate, $2.9 trillion in outstanding loans across the American banking system. Regional banks hold $1.5 trillion of that, 52% of the total exposure. Office buildings are experiencing structural collapse. Vacancy rates exceed 20% in major cities, compared to 10 to 12% before the pandemic. Property values have fallen 30 to 40% in gateway markets. Remote work isn't temporary, it's permanent. 1 billion square feet of office space is now functionally obsolete. The refinancing wall is approaching. $1.5 trillion in commercial real estate debt matures between 2024 and 2027. Properties that were purchased or refinanced when interest rates were 3 to 4% now face refinancing at 7 to 8%. Many properties can't generate enough cash flow to service the new debt payments. Defaults are rising. Office commercial real estate delinquencies hit 7.2% in the third quarter of 2024, up from 2.1% in 2022. Regional banks are trapped. They can't lend aggressively because their own balance sheets are impaired by unrealized losses. Small business loan origination fell 23% year over year in the second quarter of 2023. Commercial real estate lending standards have tightened sharply. But the lack of lending accelerates property value decline, creating a feedback loop where credit tightening causes the very defaults banks are trying to avoid. Post-crisis, deposits shifted dramatically. JP Morgan Chase gained $37 billion in deposits during the crisis months. Bank of America, Wells Fargo, and Citigroup saw similar inflows. Money fled from regional institutions to the giants perceived as too big to fail. The top 4 banks now hold 40% of all deposits in America, up from 37% before the crisis. More than 40 regional banks trade below book value, meaning the market believes their stated assets are worth less than reported. The consolidation wave is accelerating with 200-plus mergers expected in 2024 and 2025. What hasn't been fixed? Banks still classify bonds as held to maturity to avoid marking losses to market. There's no requirement to hold capital against duration risk. Basel III still assigns 0% risk weighting to Treasury securities. Stress tests don't adequately model rapid interest rate changes. 40% of all bank deposits, $7.7 trillion, remain uninsured and vulnerable to instant flight. The structural incentives that caused $620 billion in unrealized losses remain unchanged.